What's going on, everyone? A lot has changed over the last 2 weeks besides my clean shave, and I'll be going over the local changes and the new economic influences shaping the future of the housing market. Plus, one story this week is covering how Fannie Mae is offering a new way to finance an addition for rental income onto an existing property. That's all coming up in this week's housing market update, so let's get started. Hey, thanks for joining me today. I'm Rick Harrison with MVP Realty in Southwest Florida, and on this channel, I bring you the latest market news so you can make better decisions when it comes to buying, selling, and investing in Southwest Florida real estate. If you're new to the channel, welcome, and if you haven't already done so, please consider subscribing and hitting that bell so you don't miss out on the latest data, tips, and news, keeping you ahead of the market trends. All right, I wanted to apologize for missing last week's update video. These videos take me a long time to put together and edit every week, so I've invested in some additional technology that will let me stream live and reduce a majority of the editing so I can put out multiple videos each week and start adding in the Sarasota and Tampa area markets as well. So please leave me comments and let me know what questions you have about the area, the communities, the things to do, and anything else related to Southwest Florida or real estate. And with that out of the way, let's take a look at the 7-day market update. All right, so in this week's market update, I'm actually going to be combining last week's update with this week's update. I've created duplicate slides for the market update, the inventory, and I just put one together for the interest rates. So the first slide in each of the duplicates will be from last week's update. So this is 2 weeks ago compared to last week. New listings went from 933 to new listings at 902 this week. So that's down 4%. Solds went from 940 2 weeks ago to 1088 last week. So that was up 16%. However, that is a lagging indicator because those homes were started going under contract 30 to 45 days prior. The leading indicator, however, is the pending, which went from 929 2 weeks ago to 918 last week. That is down 2%. And even though that's not that much when you combine it with this week, as you'll see, the trend line is continuing down. The big thing here was the huge increase, up 20% price decreases from 2 weeks ago at 652 to 788 last week. And now as we move into the next slide, this is last week compared to this week. So new listings went from 902 to 914. That's up 1%. Solds went from 1088 down to 878. That's down 20%. So that is really showing us now that we're 3 months into this trend line, we're starting to see the effects of, the amount of homes that are going off the market after 30 or 45 days. So that's showing that there is a huge decrease in demand from buyers. Pendings went from 918 to 887. That is a leading indicator, and that is down 4%, showing that less buyers are entering the market. Again, the price decrease was at 968 this week, so that's down slightly. That's now second most since I've been tracking this over the last 10 to 12 weeks. All right, moving on to the next one, the inventory breakdown. Single families 2 weeks ago went from 3450 to 3682. That was up 232 points. Homes. Condos went from 1725 to 1789. That was up 64. So we had a net gain from 3 weeks ago of 353. Then it went down slightly to a gain of 296 2 weeks ago. Multifamilies didn't change at all, and foreclosures only went down 1. Now this week, the current inventory, 3682 last week to 3836 this week. That's up 154 new properties. Condos went from 1789 to 1882. That's up 93. So last week we had a 296 net gain, and this week is 247 for a combined 453 new listings on the market over the last 2 weeks. That's net gain. Multifamily still did not change again this week. So that's really indicating that's 2 weeks now in a row, 3 weeks now in a row where there's really not been any gain or loss in multifamilies, which is showing that to me, it's indicating that the prices are just too high. The buyer demand's not there, and there's really not much room for the profit anymore, unless you're paying all cash and you're just looking for somewhere to park your cash right now. Foreclosures last week, 43 down to 39 this week. That's down 4. So again, really nothing's changed with the foreclosures. Again, it does on average, it takes 3 years for a property to really get foreclosed on. Interest rates. So this is just a comparison from 2 weeks ago to this week. It really didn't change too much from 2 weeks ago. However, if you compare it to last week, it changed quite significantly. It went from 5.6% last 2 weeks ago to 5.669, so basically 5.7% this week. That is up slightly. Again, keep an eye on the 10-year bond, the 2-year bond as well. Bank rate had the average going from 5.27 2 weeks ago to 5.78, so that is up 51 basis points, almost a half a percentage over the last 2 weeks. All right, real quick, for any buyers or sellers, there's a link in the description that takes you to my site, which is loaded with tons of free tools, resources, calculators, and guides for every step of the buying and selling process, plus our property search engine that's plugged directly into the MLS, so you can get the fastest property updates, save searches, and set property alerts without being harassed by 20 different agents. And if you have any questions, feel free to reach out with my contact info, which is also in the link as well. All right, now on to the headline highlights. All right, so I have 5 stories this week, but before I even get into those stories, I want to talk to you about the CPI data that came out. As I'm sure you've all have heard, the CPI data was up from last month. So while last month it looked like it might be peaking and we were seeing the top of it at 8.3% because it did decrease slightly, this month now we are seeing that the CPI has again increased. So it looks like over the past 3 months, it actually looks like it could be accelerating because the 12-month is showing the 8.6, but over the past 3 months, we've seen that core inflation rate really start to accelerate a bit. So that's a little worrisome, but again, we'll have to see what happens. The Fed, although they started quantitative tightening in the beginning of the month, the bonds did not mature until the 15th. So we really won't see the actual effects or actually them tightening and releasing some of that balance sheet until the 15th. So in 2 days, we'll see that and how the effects will probably play out. I'm sure we'll start to see everything in the next week or two. But also today, the bond market was pretty hot. The rates were going up in the bond market today. And then you also had obviously, alongside the bad news of the CPI data last week, we also see that the S&P 500 and the indices have really started to tail off today. So that's all going to be playing out in the next couple weeks, and we're going to see how that's going to affect the stock market, as well as Bitcoin and the cryptos. Those took a pretty hard hit over the last couple of days as well. So moving on to the first story. Rent increases, 8 of top 10 highest area Florida metro areas. And I'm going to go through these stories quickly because I do want to keep this video short for you all. At 32.8%, Fort Myers tops the U.S. metros in year-to-year rent increases. So where I live right now, that is the highest area in the United States as far as year-to-year rent increases. Sarasota, also in Southwest Florida, just north of us, 30.88%, and then Tampa 2.69%. They all made the top 5. So 3 of the top 5 are in Southwest Florida. Just to give you a comparison, renters in Fort Myers on Florida's west coast south of Tampa have been hit particularly hard. The average rent there for April was $2,073, up 32.38% from a year ago. That's the nation's largest increase. And then Ken Johnson said for some people, renting was the only way they could afford to live in Florida. And now that's becoming a burden too. And I can see that all around us. I see the rental rates, and I have lots of people who want to move down here that are really just looking for rentals right now. And, finding them is not the hard part. It's more so finding something that's within the budget that you're looking for. Next story actually goes right in hand. Second home hotspots saw outsized growth in rental home prices during the pandemic. That would include us right here. And rental and home sale prices increased more than 25% year over year in April. 4 of the 5 most popular second home destinations also included Cape Coral, which is the next city above Fort Myers, and then Naples, which is just below us down the coastline, as well as Las Vegas. The prices have increased sharply in Cape Coral, Florida, and Naples. The next most prevalent second home markets where rental prices grew 41% and 37.7% respectively, and sale prices rose 38.2 and 37.6% in those two areas. Mortgage applications decreased again this week. Mortgage applications decreased 6.5% from 1 week earlier. That does include Memorial Day and holiday. We have not gotten this week's mortgage application report yet until Thursday. But the FHA share of total applications increased to 11.3% from 10.8% the week prior, and VA share also increased to 11.4% from 10.2%. So despite the fact that applications are decreasing overall, FHA and VAs are getting the majority share now, where that's increasing. And that's most likely because prices have just kept going up. And on top of that, the rates have also kept going up. So people can't afford the same house that they wanted. The other thing is, if you can't afford the same house because that's pushed, the prices have pushed up, that is also going to require the borrowers to push up their down deposit as well. So if you can't make the 20%, sometimes it's kind of like a give and take. Do you really want to give up all that cash that you could probably save for an emergency if anything should happen, like a recession? So put less money down, go with the FHA, put 3.5% down. It's going to increase obviously your monthly rates, but at the same time, you're going to have that emergency stash behind. Or if you need to negotiate an appraisal that comes in low, a lot of sellers still aren't budging too much on those appraisals in certain cases. Next story, Americans ramp up credit card usage. And this is something that we've been talking about for months now. This was a big concern of mine because, it's a really a leading indicator of the consumer and where their money is at. We had stimulus which helped us out over the last 2 years, but that went away. And then we went through the savings rates, and now we're onto the credit cards, and it's just gone up crazily in the last 2-3 months. So Americans are continuing to lean on credit cards and loans. They surged by $38 billion in April amid the highest inflation in 40 years. So that was April. That's just after we already got March's, which March came in originally at $52.4 billion, but it was revised downward to 47.3. So we gained $47.3 billion in March, and then we increased another $38 billion in April. We are now over $1 trillion in credit card and loans debt for the consumer. So that's an annualized rate of 19.6%, and a pre-pandemic record was 1.1. We're now over that pre-pandemic record of debt. Here is the line, just to kind of put it in perspective, to give you where I got the idea of the narrative for us going through the savings. As you can see, in 2020, we had the stimulus come out, and that really helped boost our personal savings accounts. We went through it some, and then we got another stimulus check, another couple stimulus checks after that, which helped boost it. But now we went back down, and as you can see right here, we haven't really been this low since back in 2009 or so. On top of that, when you take a look at the total consumer debt, it's just taken off. I mean, we did reduce the debt a little bit, but total has just continued to go up. Moving on. So this was the story I was mentioning right in the beginning. Freddie Mac eases granny flat mortgage financing. So on June 1st, so this just took effect a couple weeks ago, Freddie Mac announced an ADU, so ADU rental income on a single unit primary residence. So that can be used to qualify for a mortgage now. So what that really is it's just an added unit onto your property. So if you had a 3-bed, 2-bath, single family home, this financing will actually allow you to not only buy the home with the Freddie Mac financing, but also roll into that financing the actual remodeling to an addition of an ensuite, basically, so that you can use that area for rental income if you wanted to rent it out or use it as a mother-in-law suite, etc. So this is a big opportunity. It's a combination loan covering the purchase of a home and the construction of an ADU. Freddie's Choice Renovation Market allows first-time buyers who haven't owned a home in the past 3 years to put as little as 3% down to build and build an ADU. But repeat buyers will, within 3 years, will need to put down 5%. Last story, migration hotspots in the Sun Belt are home to the nation's highest inflation rates. Some of the hottest migration destinations for home buyers, as should be no surprise by now with the first two stories, Phoenix, Tampa, and Atlanta have the highest inflation rates in the U.S. In Phoenix, prices of goods and services rose 10.9% year over year in the first quarter. On average, Phoenix was also the second most popular destination behind only Miami. So not only Southwest Florida, but the southernmost point and the east side, which is Miami, is number one. And just to give you the plot chart, as you can see up in the top right hand, Tampa is up here in number 3, and then you got Miami as well as Phoenix and Atlanta. So these are the major metropolitan areas, but this is just in Q1 2022. As you can see at the bottom, red flow net of user migration. So the further right you go, the more people have been migrating to those areas. And then obviously the higher it goes is the inflation in those areas. So that was a bit surprising to see, I guess, that data out on a chart. But the wall of worry, let's just real quick touch on these. Fed tightening on June 15th. So we're already starting to hear about liquidity issues, but on the 15th is when they're actually going to be, reducing their balance sheet and selling those mortgage-backed securities. So that could be the start of a liquidity issue. New home builders, we need to keep an eye out on this because I just came from a couple different actual lunch and learns where the builders are now inviting real estate agents back in, which over the last 2 years, a lot of builders cut their commissions and tried to cut out real estate agents pretty much altogether. So they were actually paying buyers not to use a real estate agent to go use them directly. Now that the market is starting to shift, the builders are starting to ask, and in my opinion, kind of beg for real estate agents to start helping them bring in buyers. They've also brought back huge incentives, commission bonuses for bringing in buyers by certain month ends. Also, huge incentives for buyers. Some of them are offering, $17,000, $20,000 towards closing costs. In addition to that, some of them also have some pretty awesome programs now that are helping buyers get better financing than what the big lenders can do. Most of those are with bigger companies, but if you have any questions on those, feel free to reach out to me. I have a few programs in the area that can help you get better interest rates than the current ones right now through those programs. Also, rolling blackouts this summer, oil and gas prices, as well as diesel, could be a potential issue as that's going to affect trade and obviously getting supplies to the stores. China, U.S., Russia tensions, lots of threats going on between all of the above. So war aid, all that money that we're spending to bring more aid over to Ukraine. Escalations, as far as, obviously the escalation would be an obvious issue. But also consumer credit and unemployment debt. We have to continue keeping an eye on this, but there were more layoffs announced last week. So that's going to be the concern, is consumer credit going up, unaffordable housing prices, whether it's rent or just buying a home. On top of that, the other thing to think about is taxes are going to be coming around. So property taxes are going to be going up this year now that we're starting to see the appraisal prices of other homes going up too. Well, that's it for this week. If you enjoyed this video, please hit that thumbs up button to let me know. And don't forget to check out the link in the description to get access to our MLS search engine and tons of free tools and resources and hot lists. And if you ever want to connect or just chat, my info is in the link as well. As always, stay safe, and I'll see you in the next video.